All right, let's get right into it. Today, we're pulling back the curtain on the rule book that keeps corporate accounting honest. We're going to make sense of the essential rules that make sure the numbers companies show us are consistent, comparable, and most importantly, reliable. Let's dive in. Think about it. When you look at a company's financial report, you're basically taking their word for it. But how can you be sure that the profit they're reporting this year was calculated the same way it was last year? Or how can you really truly compare the performance of two different companies? Are they even playing the same game? Well, they are, or at least they're supposed to be. And that's thanks to a global standard called International Accounting Standard 8, or just IAS 8. This is the rulebook that ensures everyone is speaking the same financial language. It stops companies from, changing the goalposts whenever it suits them. So here's how we're going to break it all down. First, we'll imagine what a world without these rules would look like. Then, we'll get into the main goal of IAS 8. We'll unpack its three core concepts: policies, estimates, and errors, and see how companies handle changes to them. We'll also talk about why telling us about those changes is so important. And finally, we'll circle back to why all this technical stuff really matters to you. So let's just start with a quick thought experiment. Picture a world with absolutely no set rules for accounting. A company could, say, change how it values its products from one year to the next, just to make its profits look a little healthier. Comparing that company's performance over time, it would be totally meaningless. You'd have absolute financial chaos. And that chaos is exactly the problem IAS 8 was created to solve. Its whole purpose is to make sure financial statements are reliable and comparable. You want to be able to trust the numbers and compare them fairly. Let's look at the official objective to see what I mean. So here it is, straight from the source. The point of this whole standard is to make a company's financial statements more relevant and more reliable. This is what allows you, the person reading the report, to compare that company's performance from one year to the next, and also to stack it up against other companies in the same industry. It's all about creating a level playing field. Okay, to really get how IAS 8 works, you need to understand three key ideas: accounting policies, accounting estimates, and prior period errors. And trust me, the easiest way to think about these is to imagine we're using a recipe book. First up, an accounting policy. The standard calls this the specific principles and practices a company uses. In our analogy, this is the recipe the company chooses to follow. For example, how does it account for its buildings? There might be a couple of valid recipes, but the key rule from IAS 8 is that once you pick one, you have to stick with it. No switching midstream. Next, we have accounting estimates. Now, some parts of a recipe aren't exact, right? They require a little bit of judgment. An estimate is an amount that's naturally uncertain. It's an educated guess based on the best information you have at the time. A perfect example is estimating how many years a new machine will be useful. It's a necessary judgment call you have to make. And finally, we have errors. These are just what they sound like: mistakes. An error is when you fail to use reliable information that you had at the time. This isn't a bad guess, this is a calculation error or misreading the facts. You used a tablespoon of salt instead of a tablespoon of sugar in the recipe. That's an error, plain and simple. And this table is where it all clicks into place. Look at the nature of each one. A policy is a choice, an estimate is a judgment, and an error is a mistake. And because they are fundamentally different things, IAS 8 says they have to be corrected in very different ways. And understanding that difference, well, that's the key to this whole standard. So, how are these adjustments actually put into practice? Since we've got different kinds of changes, IAS 8 gives us two different methods for handling them: one that looks backward into the past, and one that only looks forward to the future. All right, this distinction is absolutely crucial. You've got retrospective versus prospective. Retrospective means looking backward. When a company changes a policy or fixes an error, it has to go back in time and adjust its old financial statements as if it had always been done the new way. On the flip side, prospective means looking forward. When an estimate changes, like realizing that machine will last 8 years instead of 10, you don't change the past. You just adjust the numbers for this year and all the years to come. Now, going back in time sounds pretty complicated, but IAS 8 actually lays out the steps pretty clearly. The company finds the change, then it adjusts the opening balance of its equity. That's basically its net worth, for the earliest year it's reporting on. Then, it has to restate all the numbers for the previous years so you can make a true apples-to-apples comparison. And, of course, it has to tell you all about it. But here is a golden rule, and it's super important. The standard is very clear about this. You can't use hindsight. When you're fixing a mistake from, let's say, 2021, you can only use information that you reasonably would have had back in 2021. You're not allowed to use what you know today to make your past self look smarter. This makes sure the whole correction is fair. Now, making all these changes correctly is really only half the battle. The other half, and you could argue it's the most important part for people reading these reports, is explaining exactly what you did and why you did it. This is where disclosure comes in, and here transparency is everything. A company can't just quietly change its numbers and hope no one notices. IAS 8 forces them to disclose the nature of the change, the reasons behind it, and the exact dollar amount of the adjustment on every single line item that was affected. They even have to show you the impact on a key number like earnings per share. This level of detail makes sure that investors are never left in the dark. So after all that, policies, estimates, errors, looking backward, looking forward, what's the real takeaway here? Why should you actually care about IAS 8? Well, it all boils down to one simple but incredibly powerful idea. Honestly, the best way to think about IAS 8 is as the grammar of financial reporting. It gives us the structure and the rules that turn what would otherwise be a jumble of numbers into a coherent and trustworthy story. It doesn't matter if you're an investor, an employee, or a student. This standard makes sure the story you're reading is consistent and actually makes sense. So the next time you pick up a company's annual report and you see a little note about a change in accounting policy, you'll know exactly what's going on. You'll understand the rules of the game. Financial statements are telling a story. Now that you know the rules of their grammar, what stories will you be able to uncover?